Hello and welcome to the Beats Roundtable. I'm Berna Barchet. Today is Tuesday, February 11th. Our group is here, ready to talk the markets, the best investment ideas. So today with us, we have Robert Marson in sunny Florida, and we have Kevin Baker in his office, like me. Definitely Robert has a better deal today. So
17 degrees in Boston.
It's endless winter. So let's start with Robert, who's going to talk, I think, about one of our favorite stocks to talk about, Robert and I. So let's go to it.
Oh, yeah. Berna, you won this round today. It's like the Britney Spears song, Oops, They Did It Again, because Skechers is known for every 4, 5, or 6 quarters missing a number with gusto, let's say. And in this instance, the stock traded off from the mid-70s down into the low 60s on the fourth quarter report and the 2025 outlook. I am a buyer if it gets at 60 to under 60. I have a $28 cost basis. I've held it for probably 4 years, and I would use any incremental softness from here to add to the position. So let's go deeper into the numbers. They reported 18% unadjusted constant currency revenue growth, which is very significant for the third largest footwear company in the world. The U.S. business was very strong. International business was up mid-teens, I think, but there's more granularity required. Outside of China, which was down 11%, their revenue was up 20% in their international business. Okay. So every country but China is one of their biggest countries, and being down 11% sucked. Stocks had a double-digit growth in China in the third quarter, right? So some companies are able to sell more footwear in China. So these guys, it's not just a macro in China. They're definitely not executing well, in my opinion. But outside of China, the business was just extremely strong. And because of that, they moved inventory into Europe faster. They actually said they lost sales because of a lack of inventory in Europe during the quarter. And Europe was up a very strong amount as well. The company had very strong U.S. business, very strong Western world business, grew 13%, guided to 10% sales growth, which they guide to every year. And they usually beat 10%. Now, they took down earnings from the consensus of 485 down to 440 or 450. But that was not operational issues. Currency, they said, was going to be a 20% hit, front end loaded in the first quarter. And they said this new global minimum tax rate, which nobody's talking about yet, is going to hit earnings by 15 to 20 cents. So the 35-cent estimate reduction is completely due to non-operating items. Now, the last 2 years, they guided very conservatively on earnings per share, and they beat their original guide by 14% on that years. So if Skechers says they're going to make 440, there's a good chance they make 460 or 470. It's not 100%. It might not even be 80%, but maybe it's something more than a small chance of them beating that number, not insignificantly. So at $60, if you use the 440, it's 13 and a half times earnings. It will have corrected 20% from its 52-week high. And it's, in my opinion, it deserves a 20 PE. Now, if this keeps happening and they get a 17 or 18 PE, you still have a nice run from 13 times. You can still get an $80 stock out of it without my target being achieved, which is a 20 PE on next year's numbers, which would be like over $5. So I'd have $100 target price on the stock in 2026, a year from now, or 6 quarters from now. But even if we compromised and said they got back to the 17 or 18 that they've traded at the last couple of years at their high point in the year, I would believe that that's a 30, 40% move in the stock, and that's still acceptable for my holding period upside targets.
The one thing that I wanted to bring up was what I brought up with you in the right when the quarter was reported, which was that 26% inventory gain versus the 13% sales gain, which I think is the kind of thing that freaks out consumer specialists. But you just said that they think they miss sales in Europe for lack of inventory. So where is that inventory? And
they said they have more product they said with the Suez Canal problem, it's 6 or 8 weeks, 10 weeks longer to get the product there. And they have more product on the water than they've ever had. And they're trying to get to Europe fast because the first quarter is very big for European stocking. So they said the inventory's fresh. They're not making there's no need to make any major efforts. It'll be sold through, they believe. And so, yes, at a point in time, any company can have a specific issue. If next quarter is sales growth is 10% and inventory growth is 5%, that issue dissipates in one quarter. But yes, they did admit the inventory was a couple $100 million too high. It's all product on the water. Most of it's going to Europe, and they lost sales in the fourth quarter because they didn't have enough inventory. That's what they said. They're not worried about inventory. In the past, when they have had inventory issues for inventory turns, people just didn't micromanage the growth rate thing the way they focus on it. They always said, yeah, we're going to take pricing down. We're going to promote more aggressively. We expect it to be cleared in 2, 3, whatever quarters. They didn't even go into any of that. So from their perspective, they didn't address the issue that they have an inventory issue. They said they did.
mm-hmm.
The street obviously doesn't believe them, right?
Yeah, they obviously, because this company has a storied history of getting out over their skis on inventory. So it's one of those things where burn me once, burn me twice. They're not getting the benefit of the doubt, which goes back to our original conversation on this stock when it was 75. And I was like, because I don't believe in the 20 multiple. That said, I believe in a 16 multiple and $5 of earnings. I want you to text me if this gets under 60 because I'll buy it with you. But I'm playing with a different upside scenario than you, but I agree with your buy price. So
I think the other thing that they talked about was this last year. They said they were overspending for demand creation, right? They were promoting and advertising more aggressively, right? Signing up more ambassadors, right? That kind of stuff. And suddenly that level of overspend for demand creation seems to be becoming the norm, the normal new level of demand creation, not overspending, because they have a lot of, they're trying to get into the performance business. So that's going to require.
That's an expensive business to be in because then you need actual athletes and,
Exactly. So I think Wall Street got into, well, if they can grow revenues 10 or 12%, they can grow earnings 15 or 16 by getting their They were really proud of a 10% operating margin last year.
Why are they thinking about the performance space? That doesn't make sense to me. They have a great business putting older, less fashion forward people into comfort shoes, but the performance space is more competitive than it's ever been. On top of Nike and Adidas, you obviously have Hoka and On, and then you have companies ASICS and New Balance performing at a pretty high level right now too.
Right.
It doesn't make sense to me.
It doesn't make sense to me either, unless they do it in a manner that's very cost controlled, very gradual. And they see those $150 ASPs, and they get at wholesale. They get $30 ASPs at wholesale, Vernon. So they see triple that ASP. So they have in their minds, they offer everything to everybody. They're just offering another thing to everybody. And if they do it without a lot of incremental cost, I don't have a problem with it. If they poop to bed with it and it's a $200 or $300 million write-off and they really screw things up, then shareholders will be screwed by this maneuver for sure.
Last question. What did you think about the Martha ad during the Super Bowl for Skechers? I found it a little cringy myself, but
she was dancing on air. I've never seen anybody dance on air before, so I give them credit for creativity. I like the Andy Reid commercial better, but the hand modeling, and that was done at the end of the show or after, during the celebration. I was not a fan either. You there?
Hey, gang, just for what it's worth, and I'll talk about this with Jeff Mackey. I'm trying to anger everybody, apparently, here at Wall Street Beats. But you see my arrows on the chart. I think Skechers is a sale. I think it was a sale. Here is why things aren't that bad, not why they're good and getting better. And going through other ideas, I've got two other shoe companies I'm talking about on Thursday, and Nike doesn't look good. I just don't think shoes are rolling over, in my opinion, and I maybe not all of them, but I'm very cautious here.
Well, a lot of shoe companies got very expensive and very overbought. So you were right. There was some shoe companies that shareholders were looking for reasons to take profits. And I had written in our text chain or DM chain that I thought they would be ripe for profit taking. I didn't expect them to lower numbers by 10% from non-operating factors, even though I was wary of currency because, again, 65% of their sales are outside the U.S., and the dollar had a big spike. But this is the difference here is they're still growing double digits. They're still growing earnings per share, in my opinion, because I believe they sandbag the numbers. So once they go to having beat and raises again, the stock will go right back up. It's had multiple 20% declines in the last 4 years while I've owned it. And every time they set a higher high and a higher low. That's how I'm sure.
Right.
But I understand the chart is at risk. And when a stock's fundamentals turn south, I buy bad charts that are caused by overreaction with still solid growth. If the fundamentals turn like ST Micro or Intest, I'd puke those things at the first sign of trouble. If these guys were not going to grow this year and said it's a transition year, I would be out of the stock here at these prices. 100%.
Okay.
So, Bakes, moving on from our favorite shoe company, what do you got today?
I got a few things. I've got three things. I like threes: comedic timing, Three Stooges, and the Holy Trinity. So that's my jam. And at the risk of losing my wonderful moderator, I don't like it. And my friend on Thursday, Mr. Mackey, I don't like Abercrombie. And I know I'm a broken record, but I'm a broken record because I've gone back and looked at all the times stocks have big runs and roll over. And this is what they look like. I got the Prince soundtrack on my head. This is what it looks like when stocks dive. And Abercrombie is, and the 200-day just turned down yesterday, by the way. This to me is a sale. I would have sold a third here. 128 would have been the average. That's, I don't know, 15% away from where we are right now. I don't like all this pink volume down here. I don't like a relative strength of 16. So 84% of the market is doing something better. And unless the fundamentals are so stellar and becoming so apparent soon, Abercrombie to me is a sale.
There's no doubt this is trading like death.
Sorry, but I'm not gonna pander. I'm gonna be respectful, but I see this and I go, boy, I don't like it.
That's a stock I could chime in here because I've followed it for a while as well. And when it got to where it's high range, I said that fits my profit-taking panic potential model. And it's the same thing that we had happen, Bernard, with Weatherford, right? It had a 10-bagger, and then the growth rolls over and slows, and the stock goes down 50%. So I said, if that got to 100, and I thought they could keep their operating margins at 15%, I would take a flyer on it. But that's going to have to be down to 10 or 11. What's the estimate? $9, $9? It's going to have to be at a 10 or 11 PE for me to buy it. And then I'm going to have to cross my fingers that they're going to be able to maintain an operating margin that was 50% higher than what they targeted 2 years ago. And that's the question about that stock. It's if they make $10, Bakesy, it's a strong buy at 100. If they make $5 down from $9, because their operating margins revert to where they were 3, 4, 5 years ago, then the shareholders are going to be screwed.
Yeah, I see 1068 and 25 up 70%, which sounds Herculean, and 1148 in 2026 up 8. But I know what I see and I don't like it.
You got to remember 2 years ago when the stock was 25, the earnings estimate for last year, not for 24, was 250, and they dinked to $10, right? $9. So the streets could be wrong on the earnings estimate by a lot. And again, that's the issue. And Berna saw when Crocs had their step function in earnings, the market didn't pay for it right away as sustainable, and they're still not paying for it.
But a part of the problem there is that it has industry high margins. So people just, no matter how many years they do it in a row, people don't believe that it's sustainable.
Well,
I don't know.
They do it 3 or 4 years in a row, you'll get paid.
It's been 3 or 4 years in a row now.
That's an awful long time to wait. When I was talking about Abercrombie, I don't know about Crocs.
I know. No, I know. But I'm saying
3 years in a row, people will pay for it as normal.
I think there's going to be a wall of worry. Even if you roll forward a year and the stock's around here and it does these new numbers, there may still be a wall of worry. Especially for this kind of, for Abercrombie. Especially these small stocks are just known for pretty violent swings when things dip the wrong way.
Well, they have
a high fixed cost structure.
Right. And then they have product cycles, right? They hit a product cycle and they do well, and then they cool off because everybody.
I think the product cycle is still doing fine here. I don't think that there's necessarily a business problem, but there's just a sort of what's next. And it's unclear what they can do to take it up a notch. So it feels like the only way to go is down from an operating performance perspective, because they are operating very well still. The stock price is not a reflection of any kind of misstep whatsoever. The initial sell-off was triggered by missing, credit card data, not by missing their guidance or sell-side estimates. In fact, they beat all that, but they missed some magic number that people believed in based on credit card data. Yeah, there's definitely downside here, because if the operations actually weaken, which they haven't yet, then people really would have a reason to be frustrated with them.
And here's the long-term perspective. This is the weekly. And when you go from 15 to 196 in 3 years, obviously people want, the expectations go up in lockstep, and it just gets tough. And I just think it's going to be tough to, now you have all those people that own it from here to 196, and they're going to say, you know what, if you can get me out of here at a higher price, 120, 130, you're going to be finding some sellers. So I just think it's a tough slog for a while.
Probably right.
Makes all the charts that you said were on, when I was on fire 3 weeks ago, were bought at much lower prices. The stocks were bought with bad charts and disappointing, but still solid growth fundamentals. So if these guys do the numbers that you said, the stock should be up 50%. I'm just telling you that. Okay. I don't own it. I don't know about the sustainability, but there are other companies you could buy where Skechers is only doing a 10% operating margin. There's no risk in their operating margins going to 8, because they would never voluntarily take them below their 12 to 13% intermediate term target. So you have to do deep fundamental research to understand the risk to earnings in individual businesses. But what I buy and what's always worked for me is stocks that overreact to disappointing growth, but still growth to unsustainably low valuations. And I would say Abercrombie is at the top of my list for being cheap with still solid growth until they prove otherwise. But the stock market doesn't believe them. So there's going to be a resolution either way. Okay. And it's either stock's going to go up to get a fair PE, or the earnings are going to drop a lot to give it I call it reconciliation must occur when a company's stock is down and too cheap. And it must occur here as well.
Yeah, I was getting wistful with a friend the other day for FD, because FD really made this job a lot tougher. The art of going out and getting a CFA, a couple Manhattans that he shouldn't have, is a lost art. So I've done a lot of fundamental work. I've interviewed thousands of CEOs, thousands of CFOs. I've got a very detailed process, but I don't fight this. And I worked in fundamental shops, and I was like a redheaded stepchild without hair. And I had to carry my chart book under my jacket so no one would see it. And I always had, what I would do is I would have 10 fundamental reasons why I bought something initially. And then as the chart starts to look like this, I'd go really stare at them and say, you know what? 4 of those things are very questionable right now. whether it
Right.
be inventory or margins or whatever it is. I don't care. And then I would say, listen, I don't like this, and I'm gonna go move on to some other things. I don't like chloroforming my money. I'm against it. I'm allergic to it.
Mhm. So we'll see how the reconciliation occurs.
Let's hear
I'm not
the
a shareholder. I'm not a shareholder. I'm not defending it. I'm just saying if the numbers come out, the stock will have significant. If the
Well,
numbers
and,
don't,
and
the stock will go up 50%. If not, the numbers will come down 20 or 30%, justifying the move. A lot of times, people say the stock market discounts the future. I think that's a crock of shit. Okay, what it discounts is body language in real time. So when companies are having deteriorating fundamentals, it sends signals. And all the shareholders that follow these companies, especially the institutions, they know. So they start selling on the body language, but it's real time deterioration in fundamentals, and that's what they're selling. I don't know if I usually try to get inside a company to understand that so I can know if that's happening or not. And even if you know it's happening and a company misses by 5% and a stock goes down 50%, there still could be an arbitrage there. You don't have to say, geez, they missed by 5%. When I bought Chart Industries GTLS because it had a bad chart and a modest earnings cut, and now it's up 100%. So I was taking the same risk there you'd be taking if you buy Abercrombie and Fitch today. If the earnings come down a few percent or even 5%, if they come down 25%, no one wants to own a story where the estimates are being reduced by 25%. That's the kiss of death. Don't go near it. So we'll see what happens. I'm flat to stock. I don't have any dog in this fight.
I know what I wanted to say. Just so and I think you do, but members know, anytime we talk about a stock here, ETF, whatever, I put it in my system and I stare at it every single day. So if I see something really positive or really negative happening with Abercrombie, I'll let you know and I'll say, listen, go take a look at here. What fundamental changes have occurred to justify this, and then if you dovetail the fundamentals and the technicals together, then you got something. But I stare at this every single night.
So you had said you had 3 names for us. What were the other 2 names?
All right, I will boogie because I want to, since my colleague from Philadelphia likes to slip in his winners, I'm going to slip in mine, which is AUMI, and I'm going to poke a little bit of fun at my good friend Ben Bry, who says that you have to own bullion. He picks the 25-year time frame, which is a holding period that only Buffett and 3 other people in God's earth have ever deployed. But bottom line is, here are the gold stocks, the gold miners. Yes, he says they're holes with liars on top, but here's the buy. This is right out of my statement, and this is April 1st at 31 or so, and here we are at 43, relative strength new highs, and over this period it's up 39%, and GLD, which is basically bullion. It isn't like it's in your safe, is up 29% over the same period. So there are times when the miners beat the metal, and I cannot wait for his Bloomberg barrage attacking me in the ensuing days and weeks. So we'll see how that goes.
Well
Lastly,
done.
and this is, where are they now? Don't look at it. Guess what this chart is? That's enough. Kodak. I thought they were dead. They were out of bankruptcy in 2013. This is a pretty chart. That's a base, and I have absolutely no idea what's going on here. I really saw this about 2 days ago, and I'm doing some fundamental work, but it's a pretty chart. And something good is going on at Kodak. I don't have a clue what it is, but I asked my partners and members to say, hey, you missed this. There's IP buried someplace. It's RIM, BlackBerry-esque. I don't know, but...
Listen, I don't know about this time. About 2 years ago, it broke out on a lot of volume, and it was complete and utter bullshit. It was press releases of vaporware technology, meme stock. I don't know if I haven't looked at it since then. I don't know if management's changed. The first thing I would look is whether or not the same guys are in charge of it that were around at the last breakout, because the last time it did this, it was a complete pump and dump by management.
That was 2 to 40 in the middle of COVID, and this isn't the same. All that's worked off, and here's this base. But I'm doing all the above. And I'm very cynical. I like to think I've got faith. Lazarus, I have a hard time buying that. But I don't, something's going on here. And I don't know how long lasting it is, how real it is. I don't own it, full disclosure. But when things get exhumed, I get interested. So we'll see what happens. That's it.
Interesting. Let me know what it is. I'd be interested if there's anything real there or if it's just history repeating itself.
Another thing, whenever I come across a new idea like this, I plug it into Google Alerts, and there's a lot of chaff, but there's often some wheat. And you'll find some obscure newsletter writer in Des Moines or whatever, and you'll say, hey, okay, that's an angle to the story I didn't know. So just another thing that an arrow in my quiver that I try to bring out every now and then.
Cool. Let us know what you find out, because I'm curious if there's something real there.
You sound great, by the way. You sound healthy and refreshed.
Better. A little better. It's been a rough couple of weeks, but on the mend. I think that's it from us today, but congrats on that gold trade. We'll be looking for Skechers under 60, because I think Robert and I are actually in consensus finally on that trade. But I think that's it for us today. So thanks for joining us at the Beats Roundtable. If you liked what you heard, come find us online at wallstreetbeats.com, where you'll find more, our transcripts, our real-time chat, and more. So I'm Berna Barchet, and we'll be back tomorrow. And thanks for joining.
Thanks, folks.